Hello everyone, welcome to Blue Dragon Actual. So first of all, I'd like to thank everyone who has liked the What Fresher Lack in Actuary Part 1 video. And it was a tremendous response. I received a lot of messages from many people saying that they would like to see the content and they have thoroughly enjoyed and learned from the content. The Part 2 would be released tomorrow. So today's video, and I also took the time so that I didn't post any video in the meantime, so that people can actually see that video in full time and they do not have anything else in my channel distracting them, any other video. So yeah, thanks for the response. Now another video that got tremendous response was this video, which is impact on VNB for participating and non-participating product. And this has multiple channels, multiple questions. And as I keep on mentioning that if you have any question, please post it in the YouTube comment section. Do not go to the LinkedIn and ask me that question. Let's just keep the YouTube affairs limited to YouTube only when there is a question, right? Obviously, you can obviously, I will try to answer those questions if it is in LinkedIn, but in future, and there will be other people who will be posting videos in this channel. And if you just ask me a question, then they might not know about that. So please keep the question uh, in the YouTube comment section only. Now, when I posted this video, impact of VNB on participating versus non-participating, this was a follow-up video on why insurance companies sell participating business. So whatever we are going to discuss today, you have to kind of see these two videos. Otherwise, you will not understand anything about the topic that we are going to discuss today. So first you have to see why insurance companies sell participating product even though 90% of the profit is kind of given to the policyholder. Second, you have to see is this video that you can see impact on VNB for participating versus non-participating product. Okay. So in this video, there was a question asked by Mr. Pratik Haria. What is the difference between reserve considered in calculating new business strain versus the reserve considered in value of new business, right? So here, this question itself is kind of like I personally believe that Pratik has somewhat limited understanding of what is new business strain and VNB, and that's why he has asked this question, which is very good. Like the reason I'm so here you see my reply, also based on the same kind of same line that reserves a reserve. It is no direct relation with VNB. You are probably mixing two concepts with limited understanding. That's exactly what I just told, and I need you to explain a bit more to even understand what you want to ask. That is because value of new business and reserve are entirely two separate concepts, and these are not that related in any manner. Value of new business is kind of calculated at the point of sale. Reserve is an ongoing activity, and it is calculated maybe quarterly, maybe yearly, depending on how company do it. But it is published yearly. So these are two different concepts altogether. And what he tried to do is to kind of understand how reserve is kind of impacting VNB, which is not the case. I mean, that should not be the case. But what Pratik replied is, I understand that VNB is PBO profit from new business at point of sale. So he already know this, right? For all future time periods, while NBA strain is negative profit. Now this NBA strain is negative profit is not entirely correct. That is not true. So I think this is where he lacks the understanding and is mixing two concepts. Probably has heard about this two concept from someone else and he did not have a clear understanding, so that's why he's mixing these two concept. For year one of new business, is it fair to say that reserve in year one will lead to strain, but when the future periods are considered, the reserve of release of reserve of say year one creation and hence VNB does not have any major impact from the level of reserve? Now this portion, from actual standpoint of view, the last line that I read from this portion, the release of reserve in year one, creation, hence VNB does not have any major impact. So this is absolutely absurd. I mean, this would not impact VNB because VNB is not calculated at different time point, right? VNB is only calculated point of sale, which he himself mentioned. So we'll see in detail what is happening there. And also, just to clarify, I'm aware of the concept around prudence in reserve held in part one of NB strain. So leaving that aside, I'm keen to know What else is the difference in reserve under VNB and NBS calculation? So I think what Pratik is aware of all of the concept that he requires to kind of get to the answer of this question. I think where he has not put the effort is to kind of challenge his own thought process to see that if what he is thinking is correct or not. What he is assuming that what he is thinking is correct, and based on that, he's trying to interlink the concept. Had he challenged his concept, like maybe I'm not thinking correctly, and maybe that is the reason I'm not thinking correctly, then he would himself got this answer. So let's go through the detail, and maybe after the end of this, whatever I wanted to present, maybe after the end of this, every answer of Pratik would be answered, and along with this would also help many other people to kind of get clarity. And if you have any doubt left, or if you don't agree in any place with me, please feel free to comment in the YouTube section. So let's go to the answer, and I'll start from the basic, assuming that because Pratik already knows a lot of concept there, as he has mentioned, but I believe that many people probably would not have that clarity. So I'll not answer this based on what Pratik knows, but probably I'll answer based on whatever like any basic person would lack, and then from there we can build on the answer, right? So okay, so first is we have studied this in kind of CT5. Let me just increase the size if it is kind of difficult to read. So first is we have studied this in CT5, which is time zero equation. This is the point of cell equation, right? That equation, or it is also called equation of value. One of my favorite interview question. So equation of value or time zero equation states that at time zero, your PV of premium is equal to PV of benefit plus PV of expense plus PV of profit. Now, this PV of profit is VNB, which is also mentioned by Pratik here. Say this PV of profit from NB is the new business. So obviously at time zero, this is new business, and that's why it is time zero. So if we kind of rewrite this equation, then PV of profit will come here, right? Then PV of benefit, PV of expense minus PV of premium, and that will be your VNB. So obviously, when you are calculating this at the point of sale, this is calculated based on your assumption. So that's why VNB initially, when you calculate VNB, it is always an expected figure, and then after you kind of are done with the sell, right? So we obviously you're calculating VNB. You are calculating normally when you're launching a new product, or you are kind of repricing a product. You are doing that as part of business plan. So there is a different methodology, and you are thinking like let me, if I sell this much amount of this product, then I'll get this much profit. However, if I sell this much amount of this product, then I probably get more profit. So I'll target this product and that product. So that's how the entire analysis, the business planning is done, and that's how we sell product, and that's how there is a target given to different salespeople to kind of focus on particular product. There are awards, and there are commissions given, like the like if you sell more of this product, then you will be getting a higher commission, something like that. That's how insurance company kind of promote their product, right? And that's normal. It happens everywhere. So uh so in this case, what we can see, if we just rewrite this equation, becomes the reserve equation, this became the equation for the prospective reserves, which are already familiar, right? The PV of benefit plus PV of expense minus PV of premium. So at t equal to 0, obviously these are equal, right? So the reserve is 0, and we already know that. So reserve is only kept for in force policy. So this is very important. Just keep this in mind. Reserve is only kept for in force policy in life insurance, right? So you cannot keep reserve before the policy is in force. So at what point of time we are kind of calculating VNB? We are calculating VNB before the policy is in force. The policy has not been sold yet, right? That's why the business planning is happening. So that's why there is no direct relation between VNB and reserve. So you are calculating VNB at a time when the policy is not in force. So that's why there is no concept of reserve there. But after the policy has become in force, which is may say T0 plus, like just after you sell the policy, T0 plus, right? Time equal to 0 plus. So at that point of time, you can calculate the reserve because the policy has become in force. So this is a very important point that you need to keep in mind for understanding the answer to this question, right? And that's why we see that the second point kind of mentioned by Pratik here, that the reserve is released. I think, yeah. future periods are considered, and the release of reserve, say of year one, would kind of consider to be as profit. So that's why you can see your profit lies in your reserve, right? As and when the reserve get released, you will realize your profit, because your previous profit is equal to your reserve, right? That this is the reserve equation, and that's why we say that when the reserve is released, depending on whether your experience is equal to your best estimate, or your experience is better than best estimate, or better than what you have assumed, then your reserve would be released, and then you will make profit, right? So you can see that reserve equation itself implies that the profit is kind of captured in reserve, and as and when the reserve would be released, you'll get the profit. So I think I have, till this point of time, it is very clear, right? So the equation of value is, I'll just summarize what I've said till now, just for the benefit of everyone. So equation of value or time zero equation state that PV of premium would be equal to PV of benefit plus PV of expense plus PV of profit. When we kind of reverse that, we'll get PV of benefit equal to P plus PV of expense minus PV of premium, which is the reserve equation, actually the prospective reserve equation. So that is your PV of profit, and PV of profit is nothing but what we call VNB. VNB is calculated at a point when the product is not in force or the policy is not in force, and that's why it is actually an expected VNB, and then when we get the acquisition expense, it would be a VNB after expense overrun, right? You have seen that in my previous video. So that is the reason that, and we also know that because this shows that PV of profit is equal to PV of is equal to the reserve, so the profit lies in the reserve. When you release the reserve, the profit would be released, right? So up to this point, we know. Now we have also kind of understood and kind of clear that reserve is kept only for enforced policies, right? Reserve is kept for enforced policies only in life insurance. So now we'll come to the definition of initial strain. So initial strain means time zero reserve, right? Time zero reserve means T0 plus. Obviously, T equal to 0, the reserve is 0 by this equation, right? By this equation, T equal to 0, reserve is 0. But at T equal to 0 plus when the policy is in force, so then that is time zero reserve, and that plus the acquisition expense would be your initial strain. Now the question is, where is maintenance expense? So maintenance expense is considered in time zero reserve, right? Because reserve is forward looking. Because reserve is forward looking, and acquisition expense, the incidence of acquisition expenses before the policy is in force. So reserve would not consider the acquisition expense, right? But reserve would consider the maintenance expense because it is forward looking. Maintenance expense would happen some part, because that is why it is maintenance, right? So maintenance expense would happen later in the year. So time zero reserve consists of the maintenance expense part, and the acquisition expense is kind of considered to calculate the initial strain. Now, why there is a strain? Why this term is used, initial strain? That is because reserve is calculated in Indian scenario, or in maybe in Solvency 1, reserve is calculated in prudent basis, which is once again what Pratik has mentioned, prudence in the reserve, right? So because reserve is calculated in prudent basis, this is expected to be greater than 0, right? And then acquisition expense would also add to that thing, because acquisition expense can never be negative, right? So the premium that you are receiving, obviously at initially if the reserve is greater than 0, then it is expected to be a big figure, because there is prudence, and acquisition expense is adding to that big figure, and for that, what the cash flow that you are receiving would be premium, right? Maybe say 15,000, 20,000, 30,000 rupees, right? But this would be 1 lakh rupees. So that's why there is an initial strain. But this initial strain would go away, right? This initial strain would go away if the reserve is kept on best estimate basis. Why? Because you expect in the long term, in the long run, this PV of premium, the PV of premium here would be greater than the PV of benefit, because otherwise there is no point in writing the new business, right? Because if your PV of premium is not greater than your PV of benefit and expense, then why should you write? There would be no profit. Then there is no point in writing any new business, right? If you would not be able to, you would not want to write a loss making product, unless there is some other reason, unless you are trying to kind of get into the market. So that's why in IFRS 17 there is a concept called onerous policy and non-onerous policy. For non-onerous policies, it would always be the best estimate reserve would always be negative, and acquisition expense would increase it, but it increases very slightly, but it will still be a negative figure. So that's why in that case, the premium that you are receiving would obviously be greater, because premium would be positive, and you are comparing that with a negative figure. So in IFRS 17 or in best estimate calculation or in market consistent valuation, there is no initial strain. The initial strain only rises because of prudence in reserve. right? So all three concepts that Pratik has kind of jumbled up is, I believe, is now clear. Now let's relate this concept. Also, and another concept is year one profit. Year one profit will be collected at the end of the year, which will depend on how the experience has been for that year for the insurance company, right? Here, I mean, there might be more deaths, there might be less death, depending on your assumption. And if your if the number of deaths are, say, less, then you would have made year one profit. So we now, what we have to understood is the incidence time of this. So VNB is calculated at a time when the product is not, policy is not in force before, right? Reserve is obviously calculated when the policy is in force, and year one profit, because by the very definition, year one profit is calculated at the end of the year one, because otherwise you will not get year one profit, right? Year one happens at the end of year one only, so that's why you get year one profit. So VNB would only give you an estimate at the start, like if this policy is sold and if this is the this is the expectation, this is the assumption, then we'll get the reserve. So obviously, because of that, VNB is calculated on best estimate basis, because you don't want to kind of inject prudence into that, because that is a measure for shareholders. The shareholder is interested in profit, and that is why VNB is kind of projected on best estimate basis, right? Usually that is the case. Someone can also apply some degree of prudence in that, but VNB should be projected on best estimate basis, because we know the pricing basis. VNB is coming from where? Pricing basis. The pricing basis is usually on best estimate basis. The prudence is captured in where? The prudence is captured in reserve. So as and when the prudence would be released, the VNB concept will be converted, or would be kind of changed to a different concept. It is called VIF, value of in force. So value of in force would be kind of similar to VNB. It will just not consider the acquisition expense. It will only consider the maintenance expense, because value of in force would be at a particular point of time, and from that point of time, it will again project it and see what would be the. So the concept is similar to VNB, is just it is at a different point of time, which is not the point of sale, right? So then it would not be VNB, because VNB can only happen at point of sale. When you are kind of determining VNB at other points, at in force point, then it is called value of in force, right? So your release of reserve would result in profit, and that what that profit would be at a particular point of time would be determined by VIF. It is not determined by VNB. So if you have to kind of establish any connection between VNB and reserve, there is no such connection. However, you can establish a connection between VIF and reserve. Why? Because the profit will be released from the reserve. If you are assuming that given at this point of time, if the experience would be same as best estimate, then the profit would be released in this pattern. And if I discount it back at today's day, then that would give me the value of in force, which would be the same concept as VNB, but that is not called VNB, because that is not the point of sale. That is called VIF. So there is a relation between reserve and the profit released from the reserve and VIF, but not with VNB, right? So I think that's where the question that Pratik asked was kind of jumbled up. He was kind of thinking from VNB perspective, and he was thinking in the right direction. He just probably didn't know about VIF. Like VNB would be converted or not converted. That is not the right term. VNB, similar concept to VNB would be VIF, where acquisition expense is not considered, only maintenance expense will be considered, and that's the VIF, right? So I think if we now consider this question, reserve or reserve, I have mentioned it has no direct relation with VNB. I have answered why there is no direct relation, and you are probably mixing two concepts. So that is also kind of answered, that VNB and VIF are two different concepts. What he tried to understand is VNB's PV of profit from NB at point of sale, while NBS is strain negative profit from year one new reserve. Is it fair to say that reserve at year one leads to strain? Reserve in year one is, once again, that is not the time zero, so that should not be considered in the initial strain, because reserve in year one, right? Reserve in year one, if I call reserve in year one, that would be at t equal to 1. That is not part of initial strain. Initial strain reserve would be time t0 plus, right? So this is not correct. Leads to strain. This would not lead to strain. What leads to strain is t0 reserve when future periods are considered, and release of reserve creation. So release of reserve would kind of impact the VIF, not the VNB. And VNB does not have major impact on the level of reserve. So obviously VNB would not have any impact because it's not directly related, right? Reserve can be calculated on best estimate basis in market consistent valuation, or in Solvency 2, or in IFRS 17 reserve is calculated on best estimate basis, and that's why reserve would be negative, right? Because you are, if you are writing a product on profitable basis, which you are expected to do, then PV of profit would be much higher than PV of benefit and expense, and reserve would be negative. Right. And also, just to clarify, so I think this point has already been covered, that because we are kind of writing the reserve or kind of considering the reserve in current Indian scenario as prudent reserve, there is initial strain. The moment we kind of get rid of that prudence, it is not, there is no strain, right? There is no strain unless the policy is kind of written in non-profitable basis or loss-making basis, and companies might do that just to gain market share. But usually that's not the practice. And I mean, personally, had I been the appointed actuary, I'd not suggest that. Right. So that's, I mean, that is, I think now this question is clear. So Pratik, if you can comment, if you are clear with the answer on my YouTube section, and anyone else also can, comment on whether there is any portion that is not clear. If you have liked this answer, please give a thumbs up, and please hit the bell icon, please subscribe. And I also remember that there are two more questions. One is related to risk discount rate and investment income, or something like that. And there is another related to VNB only, which is assumption change and demographic and economic assumption change. How is that kind of impacting VNB? So both this question would be answered in time. But for tomorrow, just watch out for the part 2 of what freshers lack in actuary, and it would be a tremendous learning experience. And because 21st August is a actuaries day, so I'm going to release a special video which is called the power of an actuary. Please do watch that video, and I believe that you'll gain a lot from that video. Thanks for watching. Please like, share, and subscribe. And yeah, see you in future videos.